Yes, sir. And just to confirm, sir, once again, as per discussion with Salish, we are allowed to record the session, right?
Yeah.
All right. Thank you so much, sir. So let's begin with the question.
Sure.
All right. Sir, our candidate Deep, first of all, had a set of questions, so I will introduce Deep. So Deep is from our FinBiz program, and he's right now working as an analyst with Astute Management, which is sort of a family office in Mumbai. Right. So Deep,
yes,
please, you are welcome to ask your set of questions.
Yeah, hi sir, hope you are doing well. So
yes.
Sure. So I'll start with my initial question. So I have a dilemma. So in my initial part of career, whenever I have this discussion with people I meet about portfolio strategy, which is concentration and diversification. So people following a diversified strategy have this thought process that it's always better to have a diversified portfolio, so that suppose if you have a stock which is your highest allocation stock, if that goes wrong, and because even the capital is scarce when we are just starting in our journey, so that might put us back in our career by say 2 to 3 years. So that is what they have their thought process, and people who follow a concentrated strategy, they have this thought process that it's better to follow this because it is actually quite difficult to follow 15 to 20 companies together. So I wanted to know that when you had initially started your journey, what strategy did you used to follow, and has it changed now? And if it has changed, what were the reasons which led to a change in strategy in your portfolio? That was
so a couple of questions here. One is essentially what's been my experience with diversification or concentration. One, and the other one is if I get to understand, since you're at the inception of your career, what strategy should you follow? So obviously there is no right answer to this, because concentration risks, the concentration has its risk and it has its benefits. So in a market which does well, or in an economy that does well, if you latch on to a particular company that's doing well, obviously the benefits pay off significantly higher. Diversification, on the other hand, gives you a more gradual return, but it also eliminates volatility in the entire portfolio. So you got to choose, and that choice comes with you with experience and over a longer term period. So like I said, you run a concentrated portfolio, you get higher volatility. You run a diversified portfolio, you smoothen the curve out. And that will come to you over a period of time, like it's come to me, where we've been able to figure out that our sweet spot is between, say, 20 to 25 companies per portfolio. We also run 15 companies at points in time, so I could theoretically expand that number from 15 to 25 companies, but that's our sweet spot. We don't do anything below that. We don't do anything above that. So there's no right answer. You will have to go through the entire journey to see what fits your investment style, your investment horizon, and that will come to you over a period of time.
Thank you. So just to add on Deep's part, sir, how did you start? That's what we would like to understand. Did you start with concentration or the diversification mindset?
I think we always start, and this is the same with everyone else. You always start with one company, then you add another one, then you add another one, then you add another one. So obviously, my initial portfolio constructs when I was a personal investor was more diversified than it was concentrated. But the first 5 or 10 years, you actually made market returns or less than market returns. Okay, so it's never been the case that in the first 10 years that you actually, at least in my case, never been the first 10 years that I did anything better than what the market did.
Okay, that's really great to know. Sir, shall we proceed to question number 2?
Sure. Yeah.
Do you have anything to discuss more on that part?
No. I think he has answered it quite well.
All right. Just can you be a bit closer to the mic and speak the second part? Yeah.
Sure. Is it now more audible?
Yeah. Perfect.
Okay. So second question I have is so the question actually is what does it actually mean being wrong about, say, a stock or industry in your framework. Because what I've seen in my own personal journey is, since say if I've added to a stock, say in my I added to a stock in my initial part of when I started my journey, and that stock has actually done nothing even in this bull market. So when do you actually exit that stock? Do you keep waiting, or when do you realize that you had actually gone wrong about this stock and it's better to exit and have a say enter a new particular stock or industry where the return you feel is much better, can be much better?
Again, I think when you buy a company, it always doesn't go up. You would want a great business to be at the same price for a number of years so that you can accumulate it over those number of years. Right. So even if a company doesn't do anything over, let's say, 3, 4, 5-year periods, you would necessarily need to hold on to it if you know that the business is doing well, the cash accrual is great, and the company is never going out of style. And if you keep doing that, the paybacks will come, and those paybacks usually come in a year, maybe a year and a half. Okay, and that has happened multiple times before. So you should never. I don't think there's ever a time period, unless there's something dramatically wrong either with the industry, either with technology in the industry, or there's something wrong with the management itself. So we don't wait for drawdowns. If there are drawdowns, if a company is available at, say, 100 rupees a share and it goes down to 50, but the fundamentals have actually improved, so you're getting twice as much as what you paid for in the first round with better fundamentals. Okay, and that's how you have to put it together. So your self-discipline usually needs to come in when your original thesis of why you bought the company is actually broken.
Sir, just to add on Deep's angle here, suppose, sir, like I'm just taking your example. Suppose the stock was very undervalued at 100, and because it was very undervalued, you already had your positions full. For example, you have a 10% threshold for a particular business. So you invested 10% at cost in the portfolio level. Now, because it has dropped, so the current portion would have, dropped down to, let's say, 5%, 4% after a 50% drawdown. But at that junction, the dilemma enters that because the business is actually much more undervalued, but we also think about position sizing at the same time, that if I end up adding more here, my investment at cost actually would go up very high. So do you wait for the stock to stabilize, or if it has become actually, in fact, more undervalued, you, without caring about the cap of the portfolio, you will keep on adding to that?
So from a portfolio management standpoint, if you need to allocate capital to that business at about 10%, you continue to keep doing that. And it is always on the value of the portfolio or percentage of the stock on current price to the value of the portfolio is what is relevant rather than at the cost level. And like I say, if you have spare cash coming in, and that very often happens. So let me explain it a little differently. If you put a equal weighted portfolio into place, 10 stocks equal weighted, right? After 2 years, those equal weights will actually get disrupted, right? The best of investors have a 55% strike rate on companies. The best of investors, and 55% strike rate is like huge. Okay, the normal investor gets it. I mean, the normal successful portfolio manager that outbeats the index on successfully gets between a 40-45% strike rate. So 55% is like the other end of success. So there is always, you always come into a position wherein the tail of the portfolio shrinks and the top end actually increases, and you'll have to correct both. So you usually take money from the top and put it into the bottom, and that's how you keep adding to high conviction ideas which are losing money and sell high conviction ideas who have delivered in the past. But I'm not, I sometimes don't advise people to sell their winners. You can write your winners as long as you build the conviction that you have to stay the course of when that business matures.
Okay, so that was actually I was just coming at, because the counterpoint of that was, keep on riding the winners, because you get limited winners as per your strike rate
Yes.
in equity markets. So just to summarize, because this is actually a very important learning for every one of us here, we should only sell our winners and add back to the companies which have lost in proportion when we find them equally good
Yes,
as
yes.
compared to our winners.
There's always comes a point where you need to revisit the companies that are not doing well. But when you revisit the companies that are not doing well, you have to revisit the reason why you bought them in the first place. There is so much noise in the street that we all get carried away with what happened in the last quarter results, on the last conference call, on the last research report. But the reason why you bought these companies are not because of the last quarter reports or the last and the last analyst report that came onto your table.
Correct, sir. Correct. Absolutely brilliant, sir. Thank you so much. Deep, any further thing to add?
No. So I think he's again answered it.
All right. So Deep, the last question from your side.
Sure. So again, coming back to portfolio strategy or say investment strategy. So there have been quite a few styles of investing now: value investing, momentum investing, growth investing. So when you had initially started your journey, how did you realize that value investing is what has been doing well for you or will do well for you even in years to come? And say, so when you had initially started your career, did you start with say, only one strategy for say a few years to understand if it will do well for you, or was it a mix of all the strategies to get to a conclusion?
So in my career, I've been called a lot of things: growth investor, value investor, stock picker, right? And those are nomenclatures I let the street deal with.
Right.
Okay. In the 2000, I was chasing tech stocks like everybody else. Okay. The thing is, I didn't repeat it in 2008 and 9. I wasn't chasing infrastructure at that point in time. In the 90s, 1991, I was chasing everything that we computed a higher replacement cost.
Correct.
Theory in 91. So when you start off, you don't get typecast whether you want to do value growth, because you don't make sense of what is value and what is growth at that point in time, nor do you know what the difference between a replacement cost, book value, and to an extent price earning multiple is. You just buy something that you like, and to an extent buy the cheapest stock that is available, where you think that all is required is you need to buy a cheap stock and everything else will work well. But those things also don't work. So to give you to answer that, don't get typecasted. Let your experience dictate what kind of investor you are, and always work and always do what has worked for you the best. Okay. Never repeat mistakes. Always repeat your success stories.
That's actually a great one-liner. Deep, clear.
Yes. Much better and much clear now.
So do you guys make a list of your mistakes?
We'll start from today onwards itself.
I have another thing to say. I mean, if you go back and see most successful investors, most of them made all their money after the age of 55. All of them. Okay. And it was not rocket science, because after that they just stopped making mistakes.
Exactly. Got it, sir. Thank you so much, sir, for this insight. Also, sir, if I can, sir, just kindly request you, can you, sir, speak a bit louder, sir? The voice is
Sure.
coming.
I will do that.
Thank you so much, sir. Thank you so much, sir, for answering everything Deep had to ask. Now I would invite Samyak Jain and Charchit Malu. They are currently, students in our academy. So I would request, Churchit, if you can go ahead with the question.
Sir, I like feeling blessed to have a conversation with you. I hope you're doing well. So, in an interview, like you have said that China stopped manufacturing goods. So, like as a result of which, China stopped exporting deflation.
Mhm.
And inflation is a good for a company's profitability. So just uh, wanted to understand two things, like have exactly inflation is beneficial, like
Yeah.
How exactly is inflation beneficial?
Samyak, if you can also pitch in with the question.
Yes. Good evening, sir.
I
So the question regarding inflation was how inflation is exactly beneficial, because when there is inflation, the benefit due to higher realization would
Hmm.
be nullified by higher cost due to rise in input prices.
Hmm.
So do you did you meant when you meant that when you said that inflation is good, did you mean that it is only good for companies with pricing power?
Hmm.
Just wanted to understand your point of view that how exactly is inflation beneficial?
Okay, so I was actually working on this, and if I can just share a slide with you,
Sir, yeah, so that will be excellent. I will open multiple participant sharing. Yes, it's done, sir. You can share your slide.
I'm just working on a presentation, and this should give us a fair idea of what inflation is all about. Okay, right. So this, we've all seen what happened to steel prices, right? So this was steel prices in 2019.
Sir, you haven't shared the screen yet. Sir, 1 second. Yeah, now your screen is visible. Yes, sir.
Okay, perfect. So we've all seen what has happened with steel prices, right, over the last 2 years, right? And this has not happened with it for over a couple of decades. So steel prices in India moved from 51,000 rupees to 77,000 rupees between 2019 and 2022. Right? See what it did with Tata Steel's EBITDA. It moved it from 30,000 crores to 60,000 crores. Now what happens to cash flows? Okay, cash flows moved, and this is what happened to net debt. For the company, net debt peaked in 2020, right? And post all the cash flow, this is what net debt will be at the end of the financial year. So what did inflation do? Okay, and why did we take Tata Steel out here? We took Tata Steel out here because he's the most integrated player in the entire structure.
Correct.
Okay, and that's what happened when his balance sheet actually cleaned up. Now, what does it do for the government? So it helps the government with all the optics possible and all the great optics possible. So you will hear every minister and every governor across the world, not just in India, go across saying that we met all our target exports. We met all our targets, we collected all our revenues, etc., etc. So let's look at the case of engineering exports in India. Engineering exports in India between 2019 to 2021 was up 36%.
That is
Okay,
correct.
iron and steel exports were up 94%, and non-ferrous, which is copper and aluminium, was up 84%. Okay, now these are significant numbers, but what you need to realize that steel prices had grown 78%.
Right.
What we exported was nothing more than price.
Correct.
Okay, and whatever went into engineering, and it's very commodity intensive. So for anything that you manufacture out of engineering, you need steel, aluminium, copper,
Correct.
and power. Okay, and that was up just 36%.
Correct.
So you can actually see the optics of how it is happening. And the third element, which is probably what you will see most governments get addicted to, is collections, tax collections. The tax collections hit them all-time high. They are up 38% higher.
Correct.
Remember, tax collections are at nominal, are at selling price of a product. If a product price is up by 100% or by up by 50%, tax collections will climb by 50%.
Correct.
Okay, now you get a sense that this is the case of Tata Steel. This is the case of how it happened in engineering exports, and this is how it happened in GST. Okay. So in short, this is what inflation is all about. Okay. It's a tax without a legislation. And if you go into this year and in the next budget and budget deficit, you will see the government becoming super rich over the next couple of years.
Yes.
Which is why I tend to believe, or to a very large extent, we believe that inflation this year, this decade, will remain elevated because the government wants it to happen. It's a transfer of capital, like there's a transfer of capital from government balance sheet, which is expansion of the government balance sheet to individuals or consumers, etc. You will have a reverse flow coming through, and the only reason that there's a reverse flow coming through is because prices will remain elevated. So in I don't know how many of you have a lot of economics background, but you will have a very high nominal GDP growth rate.
Correct.
And very low interest cost.
Correct. So this is actually contrary to the opinion on the ground that interest cost will increase, because majority of the people are actually pricing in a lot of interest hikes on the ground actually, and they are linking it with inflation, because inflation is high, interest rate will go high. The standard textbook part.
It could be there. I am not saying that interest rates will be benign as ever, but if you look back to what the credit policy has been today, they're projecting inflation at 4.5% after restructuring last year's base. So they corrected last year's base and they said the inflation will be at 4.5%. So so government, and so when everyone benefits from the cycle, there's a transfer of capital from the consumer to the from the customer stroke consumer, or from the saver to the government. Why should the government object to it?
Correct.
If I can just stop sharing that.
I think excellent slide on the inflation front. So just to summarize from the Tata Steel example, that the companies which are well integrated with the value chain, they will be able to benefit the most out of the inflationary scenario.
Yes.
And governments are actually supportive of inflation at this point of time, because it is actually leading to wealth transfer and more corpus with government to spend on activities they want to.
So integrated businesses and also businesses that have pricing power on the ground.
Pricing power. So just on this word, pricing power, because there's no question here. How technically, like, do you judge pricing power? Do you follow standard indicators like gross profit margin or EBIT margin stability, or do you have some other parameters to actually judge pricing power?
So it's about getting market share. Pricing power is about getting market share, right? And if you have to quantitatively decide pricing power on a business, because a business has a number of SKUs, okay, it's about growing volume with the same amount of capital.
Okay.
The capital employed remains static. You get higher market share.
Okay.
Okay. When you get higher market share and your capital employed remains static, you can effectively try and disrupt the marketplace by increasing your pricing.
Correct. Correct. Got it. Thank you so much for this angle. Samyak, anything more to ask on this angle?
Sir, yes, sir, just one clarification that I wanted. So when there is inflation, so in the Tata Steel example that you gave, the top line will increase. But sir, there would be an increase in its raw material cost as well.
Sure.
So on the bottom line, there won't be equivalent benefit on the bottom line. So wanted to understand how.
So if you break up the profit and loss account of any business, right? So if you take you take any company that you know about, there is a fixed cost and there's a variable cost.
Right.
Okay, what you see as a component of variable cost. So every business that has a very high fixed cost component will show an expansion of margins even in an inflationary environment.
Right.
Because what's increasing is just a variable cost. So raw materials as a percentage to sales of all manufacturing companies usually oscillates between 45% to 50%. Right?
Correct. Right, sir.
So what you need to capture out there is the other 50% in profitability. So there will always be a pressure on margin. So so let's look at it on a mathematical term. Okay, on math. If you're selling a product at 100 rupees and your raw material is 50, okay, your gross margins is 50%. Right? If raw materials goes up to 40 rupees, okay, your gross and your raw material price goes up by 10 rupees, so it's 60. Your product price goes up by 10 rupees. So you pass on the entire thing. Your margin comes down,
Percentage wise, yeah.
but
Percentage.
your realization per ton remains the same. You
Correct.
get what it's 50 divided by 100 and 60 divided by 110.
Correct.
Right,
So
sir.
what you need to realize, what you need to keep computing at all points in time is not, margin may not be a sacrosanct number to look at. It's whether the company has been able to pass on all the product price to the end customer. Okay. So you're passing on raw material inflation.
Yes, sir.
So per ton profitability is very relevant in our case. In some companies, they may not be able to do it.
Correct. This is a similar point. I think if I'm not wrong, Ahmed is also in the batch. I think this is the same point that we were discussing around a few of the APIs and chemical companies which follow cost plus model. That although their gross profit margins are showing decline in the last 2 quarters, but there are some companies we are actually able to maintain their realization per ton or gross profit growth
Yes.
if we calculate YOY figures. So I hope Samyak, sir has explained this brilliant table. It's clear now.
Yes, sir. It's clear. Thank you, sir.
Samyak, you can go and ask your next question to sir.
Yeah. Sir, in one of your interviews, you mentioned that when you started your investment journey, that is during late 1980s, the landscape was such that companies were available at close to their earnings. That is, the PE was in the range of 1 to 5. While, so had two questions in this context. First, the such phenomena such phenomena is not seen today. Like the current criteria is quality first. So when you gradually moved, when you gradually had more experience, so uh, how difficult was it to navigate through such drastic shift in approach to investing? Like, was it difficult for you to let go this existing mindset?
So I can tell you it was a very costly experience, right? And right initially, and if you guys become, some of you become very great investors, all of you become very great investors, you will navigate the entire process on how things change and how fads come into play. So the 90s, we were just off the junk bond scam in the US, and India adopted, or the 90 Harshad Mehta boom came in with a ratio called the replacement cost theory, and drew up valuations to astronomical levels, to really astronomical levels, which made no sense at that point in time.
Right, sir.
When we had the tech boom, which started off at price to book, price to earnings, price to growth, and it kept going at that, right? Till some companies went to about 150 to 200 times earnings, and some such strange number that was there. Then we had 2008, where we discovered something new out there, and then we had a sum of parts valuation that was there. And the sum of parts became bigger than the whole, or some of the parts became bigger than the company that they were housed in. And then now we have something called a quality investing and price, and you can buy businesses irrespective of their valuations.
Valuation.
So you have to be careful on how you identify each of these trends, because history is cognizant of one fact, is that all successful investors buy profitability at a price. That underlying fundamental has never changed.
Right, sir.
Correct.
Okay, and if that underlying fundamental has not changed, then everything comes and goes. It will never change even in the next 30 years of investing or in the next 100 years of investing.
Correct. Sir, my question here is, so sorry, am I interrupting?
No, go ahead, go ahead.
Sir, my basic question is like, when we already have history to guide, like we have the Nifty 50 era in front of us, where the similar pattern, there's nothing new under the sun, majority of the time. Why still that concept is then proved through data, and it's believed, like with investment horizon? So if I put across, without any naming companies here, the ROICs are in the 40-50 digits. They are increasing. Poly industry structures, high free cash flows, CAGR 15-20%. Even if you buy them at 90p, 70p, if you hold it for 10 years and you have a portfolio of such securities, the main point is portfolio of such 15-20 securities, you will be able to beat the index. And that is being proved through historical numbers. Like if you would have, a lot of Terry Smith presentation around L'Oreal is going on. Even if you would have bought L'Oreal at 100p, you would have beaten the index. So how do you actually put across such points? I'm dead sure that when you are facing markets, clients, other investors, you also might get such, contradictory data points. कि ये भी तो चलता है ना इंडस्ट्री में. So how do you actually make them understand कि लंबे समय तक नहीं चलता?
So you've seen the Nifty 50. Okay, yeah. You buy expensive companies, and to your point, if you held that portfolio for 20 years, you beat the index. If you held it for 10 years, you underperform the index quite dramatically.
Correct.
But if I start investing at 40 years old and I end up at 60 years old, okay, if I have that kind of a time horizon, then it really doesn't matter.
Okay.
But in the near term, these cycles completely incrementally flip and keep changing at all points in time. So let me, we've got a presentation and I just happen to keep this alive at the background. So I'll just share this with you. Yes. This is visible?
Yes, sir, it's completely visible.
We'll have to swap this. So this was 93 to 90 to year 2000. We've taken 3 companies. All 3 companies continue to remain blue chips and one of the oldest companies and leaders in their segment. We took Infosys, we took Levers, and we took L&T. This is what Infi did. Okay, 183% CAGR between 1993 and 2000. Okay.
Figure. We are talking about figure. Okay.
Okay, it did so well that Levers and L&T are somewhere at the bottom here. Okay, on this line. So Levers did 33% and 18% is what L&T did. Now, in a situation like this, okay, all of us and capital usually moves to the highest returning sector. So if there's an FD which is at 9% while everyone's giving 7%, everyone moves to 9%, right? So 5-year compounded return on portfolios give you, or on a particular stock gives you 30%. You tend to believe that the next 5 years will also be. That's how the human mindset works. Okay, and that's how the I wouldn't say logical, but somewhere between logical and illogical. That's the way the mindset works. And this is what happened into year 2000, 2001. Nobody saw what was coming. And when the cycle flipped over into the next decade, okay, the one that gave you the weakest return was what ended up being strong. Now there was a reason why it did that. One, it traded at 8 times earnings. And second, 8 times earnings went to 60 times earnings in this period of time, which is lasted into growth. And earnings compounded at 20% plus.
Okay.
Okay, and look at what levers did at 1.5% return. So a 33% return CAGR in the previous decade gave you a 1% CAGR
in the next decade.
in the next decade. And that flipped over again completely. I mean, the weakest performer, which was levers, actually became the strongest performer in the cycle that went by.
Excellent. Okay.
So this is a 30-year window. And on a 30-year window, I don't know if I have those things. And on a 30-year window, you did well on all three.
Okay.
You beat the index in all three, but could you survive the last 11 or 12 years decade? So which mutual fund of one, which of you, how many of you have L&T as your largest holding?
Correct.
Okay, but L&T over a 30-year cycle has given you a 13% return.
Yeah.
Okay, Infy is given 29% and levers are giving you 7%. But Infosys' entire CAGR came in the first decade.
Okay.
After that, it was very weak.
Okay.
Okay, so give you a time there is overvaluation. You have to step away from that overvaluation. Okay, I don't think I have the price earning multiple charts of this. So I don't know the price earning multiple charts. I have it on another presentation, but none the same. Yeah. So yes. So you have to step away from the obvious, but the human mind is conditioned to buy into historical patterns, and we buy into historical patterns. But once you stretch that horizon further over multiple times and look at multiple years of data or probably decades of data, you will be able to catch some element of those cycles and implement it. So you might be early. You will miss out the last 100% of a stock, but after making 500%, you miss out the last 100%. It's fine.
Okay. So just to summarize, because it was actually a big question and a lot of data points there. Just to summarize the entire discussion on this particular aspect. Point number one, if you talk about very long periods, like 20-30 years, it's okay to buy at any price if the business is continuously churning 10, 15, 20% of profit growth. But that isn't logical majority of the times, because you actually have a lot of money when you are majorly in the age of 35 to 40. That is where entrepreneurs or people who are at salaries, they actually have big disposable income to generate wealth. And if you end up waiting 20 years with no CAGR, you will turn out to be 60 with no majority wealth created. Second point, as a summary, was in the last 30 years, 35 years of your career, you have seen multiple fads coming and going. We need to be very careful with the basic foundational principle that you cannot buy anything at any price. You'll have to be very sure about in the coming 3 to 5 years, you will be able to make a reasonable CAGR from the current market cap or not. Am I right in the summary, sir?
Yeah, perfect. I mean, so this is one element of it all. Look, all investment styles work. You need that one period of time where it works. So quality at a price or quality at any price also worked at all points in time. But it worked between 2007 to 2009.
Right.
It has worked between 2017 and 2021.
Correct.
It did work between 1998 to 2001, where you bought Infosys at 40 times, it went to 60 times, it went to 100 times, it went to 150 times, it went to 200 times before it came back to 12 times.
Correct.
Okay, so if you stay the course long enough, you will always be successful as long as you are gone down that path.
Okay.
So you have to choose that path and go down that path. It works.
It works. Perfect, sir. Excellent. Thank you so much, sir, for this point of view. I think we will go to the next question. Samyak. Sir, also, sir, there are series of questions. So, sir, please guide me if you have, time constraint. So, I would get an idea to, speeden up the process.
No, I'm fine. I mean, we're quite on schedule. You just take a hard stop at 5:30. Maximum.
Okay.
Maximum.
Okay. Thank you so much, sir. Samyak, next question quickly.
Thank you, sir. Sir, my last question from my side is, when we are investing in cyclical plays, what is wanted to understand what is more beneficial as a strategy to invest in the industry leader or a combination of top 2 to 3 players of that industry? Like how should we go about to form an ideal construct in a cyclical place? Because isn't it my view is isn't it better to allocate in few top players instead of a single leading company so as to minimize company specific risk if at all it surfaces when the cycle turns upwards?
Hmm. So the choices that you make, I mean, if you're asking me what you should do, if you got a category of companies that you believe are going to do well, you might as well buy the entire category. That's what a lot of people do. So when you had this NBFC boom that went up recently, it didn't matter where you were. Even in Diwan housing moved from 0.5 time price to book to 2.5 time price to book, right? Plus he gave you a 20% CAGR on earnings. If you go back to 2000 and year 2000, the best performing companies was HFCL, DSQ Software, which none of them exist in their original format currently. Go back to 2008, it was Jayaprakash who went from, so L&T came from 8 time price to book, 8 time earnings. Jayaprakash came by 0.2 time price to book to go to almost 7 times price to book.
Right.
So as long as you found that industry, you can, and depending upon your investment style and experience, you can buy 1, 2, 5. From our construct of portfolio management, which is roughly the same, we like to stay with 1 or 2 guys in the industry and forget about the rest. Okay. And there's another construct within that we adopt is what we say is an industry is not only about steel. You buy steel and you go backwards to iron ore.
Okay.
You have to find the strongest element of the value chain and find an individual participant to complement your portfolio.
Yes, sir.
Okay, so if there's pricing power in coking coal, go out in the world and find it. If there's pricing power in electrodes, go out there in the world and find it. Otherwise, if you find pricing power with steel, just ride with one large business out there and go and do it. So there are multiple formats that can be enabled, but here we're trying to do what? Here we're trying to find efficient capital at a price. So usually it's not size that matters, it's efficiency of capital that matters, 1. 2, longevity of the business also matters. And that is why you usually align yourself with the bigger part of the place. Most solvent, largest, with the maximum amount of pricing power.
Perfect. So, sir, for example, if a sector is turning around, it is generally seen that the capital efficiency in the ancillary part of the value chain has been higher. So do you always go for the main guy? For example, if I talk about real estate, you will go for a builder, or you would go to some supplier of a real estate like Centriware, etc.
No, it's always real estate.
It's always real estate, the main guy. Okay. All right. Thank you so much, sir, with this understanding. I think we are done with Samyak question. Samyak, thank you, and Kenneth, sir, thank you so much for
Thank
all
you
the
so much,
insights.
sir.
Ahmed. So, sir, Ahmed is our student. He is right now working with Unifi Capital as an associate. So, Ahmed, you can please go ahead with your questions now.
Thank you for the opportunity, sir. It's a pleasure to have a chat with you. My question is regarding the CAPEX cycle and credit cycle. Now, you mentioned that as of today, government has a lot of cash. And on the other hand, corporates have deleveraged for the entire decade, and the last 2 years have accelerated it by a lot. Now, as of today, how does the quantum of CAPEX cycle play out? So in the last 10 years, what we saw was, in the 2003-2012 cycle, what we saw was Tata Steel balance sheet expanded 10 times. And it will be true for, say, Ultratech or other power or infra player. Now, as of today, how does that quantum play out on that high base? And second question is, in which key areas?
Okay. So don't wait for the CAPEX cycle to come, right? So what drives a CAPEX cycle? What drives growth? And this is what you have to consistently look at. Growth is not a macro environment that you suddenly discover growth that is there, right? Growth comes and growth has always been around. What we tend to look for in a corporate balance sheet, and when we look at it on an NSE 500 balance sheet out there, or in NSE, all companies in the NSE 500, we look at an ability of a company to leverage into growth. Okay. So growth might exist, but if you don't have the capital to take advantage of the growth, what's the use of growth?
Correct.
So what does a deleveraged balance sheet do? A deleveraged balance sheet actually helps you raise capital to buy growth. When does deleveraging take place? Deleveraging usually takes place when you hit optimum capacity utilization. So when you hit optimum capacity utilization, your cash flows go to its all-time high. Okay, so a business cycle starts with low capacity utilization, low pricing power. But as capacity utilization goes up, okay, you're supplying into a demand-driven market. Your pricing moves up. When your pricing moves up, capacity utilization moves up, your profitability and cash flows increase. When your profitability and cash flows increase, that's when you get your valuation first, because your return on capital employed goes through the roof.
Correct.
And that kickstarts the CAPEX cycle. So before the CAPEX cycle comes in, my sense is you have peak valuations.
Okay.
Okay.
Okay. So actually the valuations move before the CAPEX cycle actually begins.
Let me see if I've got that chart. We usually have it. I don't have that ready at this point in time, but let me just see if I've got that somewhere. Yes, I've got that one. Just give me a minute. I'll just load that slide.
Yeah, sure, sir.
Okay, so this is how we look at the market cycle. Now, this is a lot of numbers, but let's but just spare a moment. I will run you through it. This is visible?
Yes, sir, completely.
Okay. Now, this is a summary of, I mean, I've removed financials from here. So there are no banking and financial companies, because what we're trying to do is capture the debt equity of businesses in the NSE 500. Right? And we've got statistics from 1999 to 2021. 1999 to 2021. And in this 99 to 2021, this is where you've seen leverage at. One time, it moved all the way to 0.6, 0.7. It went back to one time 100% here, and then it's down to 0.7. Right? And if you look at debt equity and look at the correlation to asset turnover, and then look at the correlation to ROE. Asset turnover is the simplistic way of looking at capacity utilization. Okay, so at low capacity utilization, you are geared at 100%.
Correct.
When you went to a high capacity utilization, your cash flow generation, and you move to a repaying debt, cash flow surplus economy, and you repaid debt. Okay, high capacity utilization, high profitability, you move to a high ROE.
Correct.
You kick-started the CAPEX cycle somewhere around here. Okay, 0.6 time debt equity, and look at what happened with capacity utilization, with
Debt.
CAPEX, capital cycle, with the CAPEX cycle. And then look at what happened to your utilization level, and look at what happened to your ROEs. Now, what a lot of people tend to forget okay, that we tend to project demand. All of us project demand, and everyone says that demand will grow at 15% per annum. Now, if analysts can get that right, industrialists will also be thinking on the same path.
Correct.
So then you have legacy players that will set up capacity. You'll have new guys who will set up capacity, and you'll have guys from outside the industry coming in and setting up capacity.
Correct.
So supply comes in at 100% per annum. Demand is growing at 15% per annum.
Correct.
Which is why you have a fall in utilization level, because you set up surplus capacity when demand has not been able to catch up with the excess supply.
Correct.
Which creates the inefficiency in the market. Now, are you guys with me?
Yeah, yes, sir. Yes, sir.
Okay. Okay, which creates the inefficiency in the market. And then when you have to terminate some new capacity coming. So 2013 till now, you haven't seen a new steel plant come in. You haven't seen a new cement plant come in. You haven't seen a new power plant come in. And that's when cash flows in the cycle have resulted in basically cash flows in the cycle, and also the fact that the banks were writing off a lot of debt have really come back to an all-time low in debt equity.
Sorry, sir, you were speaking something.
So this is the way we actually map it all. Now, there's a third element to it all. Okay, the third element to it all is that there's this ROE business, ROE, return on equity, that is there, right? Now, return on equity is completely linked, or the CAPEX cycle is completely linked to the cost of capital in the system. So when business generates 25% return on equity, and your cost of borrowing, in here we've taken a proxy for a 10-year GSEC is 7, 8, 9%. The differential is 16%. So this incentivizes an entrepreneur not to put money into the marketplace, but to put money into his capacity.
Economic profits, basically.
Yes, economic profits. At this number, it doesn't exist. So this was the weakest CAPEX cycle that India has seen. And end of this year, you will see this number come significantly back. And this is the half yearly or trailing 12 months numbers that we have, 2021, where your debt equity has hit its all-time low. Yeah, your capacity utilization moved up to 71% on an average. ROE has come back to 14.6. And this is seeing its 5-year high or 6-year high already. You take capacity utilization to 85%, your return on equity will cross 20%. Cash flow will be its all-time high, you will be ready. But by that time, your valuations will be at a different stratosphere.
So at what cycle, at what point, sir, like you start analyzing ideas around capital cycle? At what junction is your sweet spot, K?
I don't think I have a sweet spot on trying to establish where I put money to work. But yes, as soon as debt of individual businesses keep coming down, we continue to allocate money into that part of the world.
Okay. So you start analyzing or generating ideas on the CAPEX cycle front when debt are actually growing through the roof, because after that, the new cycle might start.
So to give you a perspective, when I stepped out of my previous assignment and started Old Bridge, I haven't bought a single consumer business in our portfolio.
Yes.
Okay. We probably timed it a little too early, but I never understood what a 30 times, 40 times, and 50 times multiple was.
Okay.
And a lot of other businesses were trading below price to book.
Okay.
So it goes by the same logic. Like, I'm an entrepreneur,
okay,
right? I run so theoretically, I have a power plant.
okay.
Okay. The power plant I put it up at 4,000 crores a megawatt.
Okay.
The market is trading that 4,000 rupees a megawatt at 2,500 rupees a megawatt.
Correct.
Sorry, 4 crores a megawatt to 2.5 crores a megawatt. So effectively, my market price is 2.5 crores a megawatt. For a capacity I set in at 4 crores a megawatt. So as an entrepreneur, if I put in another megawatt, market is going to market down immediately.
Correct.
So what is my incentive to go out and put up a new plant?
Nothing.
So in a cycle like that, you have no new capacity coming.
Correct.
And when you have no new capacity coming, the incremental demand that is there, like 5%, 10%, will exhaust the supply that is there in the system. And that will lead to spiking power. And like you've seen in the last year or two, power prices have moved up quite significantly.
Correct.
So
Excellent, sir.
there's no way to time this. You will have to do multiple industries because all industries don't map themselves out in the same format. There are different industries that participate differently.
Okay. But the broad theme of cycles remains the same.
Every industry goes through its different cycle. A different cycle. I mean, if you look at sugar, it's got a different cycle. If you look at steel, steel largely follows a similar cycle with most of the other non-ferrous metals industries that are there. Consumers is a different cycle that is there. Technology is linked to something very different. Okay, so everything's got a different
cycle. So how would you track a cycle for, let's say, something like a IT company? Because that is where supply is actually difficult to obtain. And I think this is the next question by Emmett too, right? How to track supply in B2C kind of businesses?
So I've got a simplistic answer for that, right? And a lot of a peer group and a lot of investors tend to believe that they need to buy capital efficient business.
Correct.
Our investment process is buy a low margin, sell a high margin.
Okay.
Buy low ROE, sell high ROEs.
Okay.
And those ratios can be captured across any business.
Okay.
So Asian Paints was at 18 times earnings in 2009.
Okay.
Okay. A Page Industries IPO'd at 15 times earnings.
Okay.
Okay. So that's a cycle that we try and capture in a format like that and try to put it to work. Now, how do you capture a cycle in a B2C business? A B2C business, you invest in market access and market brands.
Sorry, sir. The last line wasn't clear. I'm so sorry.
A B2C business, okay, operates in expanding its distribution network and expanding its brand, as long as there's no competition to it. Let me see if I have something. My colleagues put together something on that, which was fairly interesting in terms of how we looked at a very interesting cycle, which was so this is where the fragmentation of a business actually takes place. Okay. We all know these companies.
Correct, sir. Yeah.
A Paints, Berger, AkzoNobel, etc. Okay.
Correct.
The industry revenue is 36,500 crores. Invested capital is 16,000 crores. Industry profit pool is 6,000 crores. Okay. 37% is return on capital employed, and the market value is 44,50,000 crores. So over 6,000 crores of a profit pool, the market value of this business is this. Okay. And when I say we sell high ROE businesses, I mean the best way to attract competition is to show your business is very profitable.
Correct.
And when it is very profitable, it has a very large market cap. And when you have a market cap and a combination of high market cap and high ROE, a lot of entrepreneurs are very interested in this industry. So look what happens here. Okay. Grasim comes in. Okay, and this is the consolidated entity.
Correct.
He's got a 900 crore profit. He's got a return on capital employed of 7.5%. He gets into paints. It's a set 37. So his asking rate is only 7.5%. Okay. He's getting into industries generating 37%. Okay. How much money has he committed? 5,000 crores in an invested capital of
16,000
crores. Okay. Distribution and brand deficiency is the key competitive, and he knows what to do there because he already got an extension in the white putty market.
Correct.
Okay. And he's got the cash flow through the diversified business. Okay. So you see how to capture a business out here.
Correct.
You got two of the largest industrialists who are going for a 6,000 crore operating profit. So what are they trying to do? They're going to approach and capture some part of that 6,000 crores of industry's operating profit. And this profit has been around since the last 20 years.
Correct.
Okay. And they're putting in just as much as capital as they think, okay, is relevant for this, for this business. So that's what we tend to look for in a cyclicality of this business, right? So yes, so how do you capture it all? I can't say we're at the bottom of the cycle because you're getting excessively large companies getting into different businesses to capture that market. And obviously there is the bigger behemoths that are there who are coming in with their own private label brands to go for the consumer FMCG market.
Correct.
There's been a category change in the car market.
Correct.
Okay, and Maruti is losing out in the SUV segment, and there's a new entrant which is Kia Motors who's creamed that market along with Tata Motors.
Correct.
You look at so when a consumer is spoiled for choice, when you have so many numerical numbers coming in, you've got to ideate whether it's the top of the cycle or the bottom of the cycle. When all this fragmentation is taking place and your ROE is at its all-time high,
Correct. Correct.
it can't go higher.
Correct. Sir, just one question to add here. Would your perspective specifically in paints would have remained the same if the challengers were companies with ROE of 25 to 30% itself? Because then I think they won't go into price competition, because right now the main headache is that a 7.5% ROCE company would be more than happy with a 15% ROCE if they are able to generate that in a new segment called paints. So the incumbents will have to drop down the prices because the new player would be selling at a much lower price. So that's the main point, or the overall supply itself is the main point?
It leads to both. 35% return on capital employed will attract competition from anyone who's got cost of capital of 5%, including banks. When you have 35% return on capital employed, or forget 35%, if you have 25% return on capital employed, the industry players will want to make 20% return on capital employed.
Okay.
So they will put up a brownfield.
Okay.
Okay. And if 20% is there, then private equity will come in at 15%.
Correct.
And if private equity is coming in at 15% and new entrepreneurs need to come in, they'll take bank finance at 9%.
Correct. Absolutely.
Okay. Now, what is all money coming into this? All the money coming in is chasing the same distributor.
Correct.
When you chase the same distributor, what happens? The distributor says that, okay, there's so many guys after me. I will shift my loyalties because after all, I'm selling a commodity with some kind of a brand name, right? And then what happens is then you start investing in your brand.
Correct.
So everyone will shout out the same message at a higher cost. So your cost line goes up, but your revenue line can't go up because the consumer is spoiled for choices.
Okay, got it.
So you
basically
get compressed at both ends. You can't take inflation, the inflationary pressures on your business up, and your cost line continues to inch upward. So you keep investing more for the same profitability. So here again, don't look for a fall in profits. You'll be mistaken if profits fall. Profits will remain the same, but the quantum of capital to maintain that profitability will go up.
go up. So ROCs will majorly reduce.
Exactly.
Thank you so much, sir. It was a brilliant angle to judge. Ahmed, anything to add on this
I
aspect?
have just a query on that slide. So in that slide, in 2005-6, our debt to equity ratio is 0.6 or thereabouts. Now, today, ratio is 0.6, but asset turnover is also very low. And there it was 0.9 or thereabouts. So does that mean that CAPEX cycle will come with a lag?
It will be it. So again, I'm saying don't look for a CAPEX cycle. Our business is not to look for what will happen. If it happens, what will happen to it? By the time the CAPEX cycle kicks in, you'll be at 95% capacity utilization. At 95% capacity utilization, what is my ROEs? If at 60% capacity utilization, my ROE is 11%, at 95%, what will it be?
Non-needed, 25, 30.
Okay.
20%.
See the thing with statistics, or the thing with waiting for CAPEX to start and then the growth cycle will start, is by the time the CAPEX cycle will start, the profitability generation is between 60% utilization and 95% utilization, you will make all your money. Not when the CAPEX cycle starts.
Correct.
So you don't have to wait, because we are playing efficient capital. Efficient capital comes between 60% to 70 to 95%. The minute you increase your denominator, what is CAPEX? Increasing your denominator.
Right.
The minute you start increasing your denominator, your numerator is not going to move as fast.
Correct.
Thank you. Thank you so much.
Absolutely. Thank you so much, sir. Thank you so much for such in-depth angles. Ahmed, anything else that you would like to ask? Done? All right. We'll move forward quickly to Akshay. So sir, Akshay right now, he is an analyst. He was our student. He's working right now with Perfect Research Delhi. They are sort of family office managing money into equities. So Akshay, please go ahead with your question.
Yeah, a very good afternoon, sir. It's a pleasure talking to you. Sir, I wanted to understand what are your views on combining technical indicators with the fundamental ones for optimizing returns, the techno funda that they call it.
It doesn't work.
Sorry?
It doesn't work.
It doesn't work.
It doesn't work.
So can you explain your thought process behind the same? Because a lot of things like momentum investing, algo trading, back-end tradings, have started making the rounds actually since past half a decade. So
these are all niche businesses. So I started there used to be a magazine in 91, 92, we used to call Capital Line. Capital Line Technicals. I used to work in a technical magazine. Okay. You can't size up a position based on technicals.
Okay.
Okay, and you can't sell a position based on technicals.
Okay.
Okay. So a fundamental business is a technical chart will tell you to sell it 20% below your purchase price. As a fundamental analyst, you will double your position at 50% below your price. So those things are conflicting. They don't go in the same direction.
Okay. So, but doesn't it happen a lot of time that businesses which have consistently traded at great valuations, or the variance in their prices are low? If such strongly bought businesses start moving towards 100-day, 200-day moving averages, and they break those averages with heavy volumes as per the index data, it actually historically it has taken 2, 3, 4 years for such business to revert back to their actual all-time high prices and we can actually rotate that money for 2-3 years to generate alpha. Specifically, if you are into an industry where your returns are publicly tracked and you are actually being caught for even a quarter or a year of underperformance.
I don't think you're caught for a year or 2 years of underperformance. Like, investors give you a much longer rope as long as you're consistent with what you're doing. So that is a separate stuff. That's a separate topic altogether on performance and underperformance.
Okay.
See, there are simple things in my career. I held MRF from 2003 to 2015. It was 110 times up.
Okay.
I held Page Industries from 2007 to 2015. It gave me an 80x or 90x. I did Kaveri Seeds. It gave me a 70x during the period that I was around.
Okay.
Okay. And there are so many businesses that are like 10 and 20 and 30x that are there. Okay. Again, I mean, Motherson Sumi was one of them.
Okay.
Why would you want to sell a business whose fundamentals are improving?
Perfect. Got it.
Okay. And the minute you say that you want to add technicals to a fundamental approach, either technicals take over or fundamentals take over, you got to decide which way you want to go.
Okay.
I can't sell a 300 crore position based on a chart because I'll make the chart.
Correct.
Or I can't buy a 200 crore position because I will make that. I'll make that chart. Okay.
Correct.
So it in practical portfolio management on a scale, even at a 3,000, 4,000 crore portfolio, it just doesn't work.
Got it explicitly said. Akshay, anything to add?
So I was just looking at it from an finding an opportunities from a point of view of finding the opportunities, sir. As they tell it, fish where the fishes are. That's the thing, sir.
So what did you do in 2020 of March? Tell me. All momentum indicators are pointing downwards. All the technical managers you put on every television manager, they kept going from lower price to lower price to lower price to lower price, right? By the time you finish hitting your stop losses, you are bankrupt. Okay, but at the end of the day, it had to reverse someday because all asset prices can't go down to zero. So no, I mean, I don't subscribe to that. I'm sure it has worked for some people, but I definitely don't subscribe to that thought process.
All right, sir.
Thank you so much, sir.
Yeah, thank you so much, sir. The next question is from Dhruv Rathod. He is right now our student. Dhruv, can you please put forward your question quickly?
Sure. Good evening, sir. Pleasure speaking to you. Sir, I had a question based on India. India consistently dreams on to become a manufacturing hub in the next decades, and we are every year this dream comes back with a new format. The government brings the dream back. This time it is in the format of Atmanirbhar Bharat. So where do you think we as a country should focus on really gain a foothold in exports or in manufacturing like that?
We created an entire IT business when there was no department for information technology.
Okay.
Okay. And that remains our problem. Our problem continues to remain the bureaucracy. The minute the bureaucracy comes in, then there remains impediments to growth. Of course, you need bureaucracy to regulate a lot of stuff, but not to determine which way the industry goes. So India will continue to struggle with that, and we'll just be participants in everything that is there. So I would not look at it from a Atmanirbhar program or anything else that is there around us, because we are a democracy. We are not a state governed. We don't have a state governed investment program
like China.
Yes, we're not dictatorial. So look at a free market economy like the US. Okay, the US, the regulators are behind the curve when it comes to regulating the digital economy.
Correct.
But then you have a $3 trillion cryptocurrency market that is evolved, and nobody knows what to do with it.
Correct.
Right. So when it comes to India, I mean, it's too small a business, and always remember one thing. I mean, you guys are coming out into an investment career. Don't look at investment from a point of view of India specific. You got the world outside. We are 3% of the global economy. Why eliminate 97% of the investment universe?
Correct.
Okay, so if steel prices, when we talk about it, Tata Steel, you just open up ArcelorMittal and see its market capitalization and look at its profitability. So structurally, everything moves together. We are not in isolation. And the most creative part of the world is obviously the West, and they've taken the lead. We will take a lead someday. Okay, but I think we're still a little behind it. This decade probably is we won't take a lead from the rest of the world, but we will be relevant.
Got it, sir. Thank you so much.
Dhruv, anything to add?
No, sir. Sir has answered it well.
So
Thank you.
just one question on your answer. Like you said, to be open with international businesses too. We can look around the globe. So do you personally in your personal portfolio or at Old Bridge Capital, are you also looking forward to investing in businesses which are good? Let it maybe in Australia or US.
So we track everything across the world. So the day we invested in a business called Electrodes, we knew everything that was happening in every electrode company in the world except for the China, because the data is not available. When we invest in steel, we know everything that's happening in the steel businesses. If you're investing in pharmaceuticals and generics in the US, we know the leverage of every single pharmaceutical company, generic pharmaceutical company in the US. So it's not. So it's commonplace that we need. So when I say that, you have to look at 97% of the investment opportunity, because their problems becomes our advantage or our opportunity. The problems in the West becomes our opportunity.
Correct.
Okay, and our problems become their opportunity, or our size of economy becomes their opportunity. So capital is the only thing which is migratory.
Correct, sir.
So yes, we do have a fairly good hold of every single industry internationally that we invest in.
Okay. So got my answer. So we'll take next question from the side of Yashtanna and Shiva. So Yashtanna right now works at iThought portfolio management, and Shivam Parekh is right now working at Omkara Capital. So Shivam and Yash, you can put your first question here.
Yeah. So sir, I hope you're doing well. So I just wanted to ask a question, like, what are the 3 to 5 critical factors, which you pass through an initial checklist before diving deep into a business, or which are those factors on what basis do you avoid investing in some businesses? So if you can just tell us about that.
Okay, so which are the 5 factors that we look at? So from a approach point of view,
Yeah.
I'm just trying to find that slide if we have it. Yes. Okay, so this is what I look at. Okay.
Okay.
And everything has its relevance out here. And always remember, this is tied in with the business, with the company specific, and with the opportunity which is at hand. So we like consolidators of a business. Fewer companies in an industry have access to the entire profit pool. More number of companies, profitability gets fragmented. Okay. We like companies that gain market share, not lose market share. Gaining market share depicts the quality of the product, quality of the management, and his ability to generate higher amount of market share with the same amount of capital. In a commodity business, you necessarily need to be the lowest cost because that helps you survive the down cycle. Okay, and leaders at the end of the consolidation cycle usually, and so this is a summary of everything which is up there. Leaders at the end of a cycle which is consolidating end up with higher market shares and then pricing power. To get all of this right, we necessarily need to have a great financial discipline. Negligible debt is preferred. No debt and negligible debt is preferred because what we're trying to do, we are trying to buy survivors in a cycle. Okay, we like leverage, but we like leverage as companies create the capacity to leverage into a cycle on the upside. Right, the growth comes in, I need the capital available with me because of my great financial track record in the past to capture that opportunity. Now let's come to capital efficiency and how we define capital efficiency. I've said this before, is we would like to buy companies from a low ROE to a high ROE. Okay, so what is a high ROE for us? If a company makes an ROE of 9% with a debt-free balance sheet, 9% debt-free balance sheet, which is lower than probably the cost of debt of its competitors, it is a great ROE because the rest of the industry is actually making a loss.
Right.
Okay.
If he's cash flow positive and he's not increasing his capital employed to stay in business, is what we define as capital efficient businesses. So we don't put a number saying that over 15% or 30% are great capital efficient businesses. If he's the only profit making company in the cycle and generating a 8%, 9% or 5% ROE, that's a place to be in, because if he makes a loss, then the industry closes down.
Right.
Okay, and valuations, obviously valuations, everyone's got a different format. What we like is, especially in the context of how we invest, EV to sales or market capitalization to sales is something that has worked for us over long term, over the long term. So these are a couple of things that we look for, and even if 3 out of 4 we can tick the boxes, it becomes very relevant in our shortlist.
Right.
I think greatly explained. Shivam, anything that you would like to add or clarify? Yeah, Shivam, am I audible?
Yeah. So I actually had a. Sir, am I audible?
Shivam, your voice is cracking.
Yeah, sir, am I audible now?
Yeah. Yes.
So when we are analyzing, say, a mid cap company or a small cap company or even sometimes micro cap companies, and if we had to rate businesses on the basis of, say, 1 to 10 and 10 being the best and 1 being the worst, sometimes companies tend to have issues, like, say, some have corporate governance issues, some don't really have the balance sheet strength, some have good cash flows, some have complex nature of businesses. So to make it short, like, for example, if a company has a good balance sheet and a very strong cash flow, but sometimes, have some corporate governance issues. So should we invest in such companies, or companies should be great on all parameters?
So how do you define reliance?
Yes, so that's a complex business over there.
So how would you define
Difficult to understand.
Bank over multiple years? Or how would you define any of India's top 10 companies? So let me put it this way. Corporate governance, okay, is a term wherein we could quantify a large element of it all. Who are your stakeholders? Okay, the stakeholders are obviously shareholders, bondholders, more importantly, customers, employees, and the government. These are the 5 large stakeholders. Of course, there's society and etc. But there's a large. If you take each of them individually, right? And let's go to the customer. If the customer continues to buy a product as a preference for everyone else, then obviously from a product standpoint, you're giving him a quality product at a price, okay, because you're getting a higher market share, right?
Yeah.
The second one is employees. If it's easy to attract talent below the market scale, obviously you're doing something right in your HR practices or in the organization, or giving career prospects that people want to join you from all competition.
Right.
Governance.
Correct.
Bondholders, very easy to explain. Government, taxation, very easy to explain. Okay, if you get the top two, which is customers and employees, the rest three are very easy to capture. So when you're going across to a micro cap or a small cap or just go and speak to the employees, or just go and speak to the customer. If they're giving you a fabulous experience, then you probably got something out there.
Right, sir.
Okay.
Okay.
That's actually a great framework. Shivam.
Right. Yes, sir. That actually answers my question.
Okay. All right. So we'll move forward to next question. So next question is now by Yash Tanna. Yash, can you please go ahead with your question?
I'm audible.
Yeah, you're audible.
So, good evening, sir. And firstly, thank you for giving us your valuable time. So, firstly, my question was so while investing in the start of a cyclical business, it's initially so investing in a cyclical business, which is just coming out of a bad phase, or let's say it's just coming out of a bad product cycle for that matter of fact. So, how much position sizing do you do initially when you think that the business will do well, and how much do you keep deploying on additional markers? Let's say when we say if the business will achieve XYZ things, I will deploy more money to this business. So the main question is around position sizing, in when the tide is turning positive or is just about to turn positive.
So I think our sweet spot has been always 20 companies, 25 companies, between 20 and 25 companies. Once we've been able to identify those 20, 25 businesses, okay, we do an equal weight amongst all of them and just let it run.
Okay.
Now, the thing about portfolio management is the company has to earn its space in your portfolio. So if you're running 20 companies at 5% each, if that company has to get 10%, you don't take it to 10%, you let it grow to 10%.
Okay. Okay.
Okay, so sizing is different for different people. There are some very conviction-driven managers who go and buy 10% in the portfolio. And that comes with experience, but that is not my style. My style is equal weight. Let it run, let the company earn its place in the portfolio. That generates multiples, and then I'm home on the other side.
Okay, got it, sir. And ideally, I mean, do you look at adding more when some markers are achieved, or it's just an equal weight run? Okay.
No, we just let it run. See, those markers are not achieved really to that sense. I mean, the better the company goes, the higher the risk it gets. Because, like I said, our investment process is buying low ROE, selling high ROE, buying low margin, selling high margin. So the minute he hits his margin profile is not, I go and add there. I tend to figure out what to do with that business at that point.
Got it. Got it. Got it. Yes, sir. Sure.
Yash, anything to add, Yash?
No, sir, that answered the question. Thank you so much, sir.
Thank you so much, sir. We'll take next question from Himanshu Bisani. He works in the investment banking division of Access Capital. Himanshu, please go ahead.
Hello, sir. Glad to talk to you. So my question is, when there is a huge industry size, opportunity size, and the potential longevity of growth in the industry is really high, the companies tend to trade at a very high price to earning multiple. But simultaneously, the industry is so nascent that the changes in the macro to predict the future in the industry is very tough. And also there are very rapid technological innovations and changes in technology in the innovations in the industry. So how do you pick out winners in this industry? And secondly, how do you value such businesses? For example, gaming industry as of today now.
Oh, this is a difficult one. So we don't look into the future, right? And let me give you an instance of this. In 2008, okay, the business of real estate only lost money. Sorry, 2008, the most fancied business was infrastructure and real estate. And real estate, you had DLF listed and went to 110,000 crores of market cap. The first cycle that came through. You had Shobha that listed and went to 8,500 crores of market cap, listed at 8,000 crores of market capitalization. And at that point in time, it was the sunrise industry, and all builders were there, from Parsavnath to Unitex to everything else there. Shobha never traded over its IPO price. The only time it traded over its IPO price was last year, end of last year. Okay, that's the power of projecting the future. You can always get it wrong, or in all probability, you will get it wrong. So that's what we don't do. We don't predict the price of the future. But given your background, coming from an investment banking background, you have to make a story. Okay, and you have to show the potential of something that doesn't exist. That's not a style that we adapt to.
I got it, sir. But to add on that, the industry has clear, visible growth over there. So you to play the industry. How do you play that industry then?
Why do you want to do it? What is clear, visible growth?
Adjacent markets. Like just talking about the gaming industry itself, the US markets and Chinese markets have really grown at a very rapid pace in the last decade, and India is at that level, that starting of that process. So to play that gaming industry just itself, if I wanted to buy a gaming business, but it trades at a 200 multiple, so how can I pick out that?
So I don't know. By all the gaming companies, you have to diversify your portfolio. I don't follow the business so well, but from whatever little I know about the category that you're talking to, profitability is concentrated on probably 2 or 3 companies worldwide. Okay, so that is your strike rate. Okay, and we all know at the end of the day, the guys who make most of the money is the guys who sell the phones.
Okay.
So today, hardware actually makes more money through Apple and to a large extent with Google than probably all the gaming companies put together. Okay. So I may not be able to answer that because I have seen a lot of projections that have always been made and which never come through.
Okay.
Got it, sir. Thank you.
Thank you so much, sir, for this answer. We'll go to next question. I think that is by Parth, Gohil, Pranchi, and Nawaz. Almost everyone had the same question. So yes, I think, yeah, we can ask this question. Parth, you can go ahead with this question.
Yeah, sure.
Because
Very
I think
good.
the first question, sir, has already answered indirectly.
Okay, fair enough, sir. So very good evening, firstly. So as we know that you have the expertise in cyclical stocks. So as a new age investor, as an individual investor, if one wants to analyze a cyclical business, so what are the other key indicators apart from the historical demand supply, apart from the historical margins of top 2-3 players, apart from tracking down the prices? And so that when can we come to the conclusion now that now this is the bottom line to enter into this industry? So I wanted your input on that actually. And what are the scenarios where such turnaround can be sustainable in nature?
So one thing, I don't know what is cyclical and what is non-cyclical, because I put up a chart sometime back, which effectively said that even levers gave you a 1% return in 2000 to 2009.
Yeah.
Okay. And so to that extent, every business has its It's cycle.
Cycle plan, yeah.
Right. And if you see the Tata, today Tata Consumer is a fairly large company. There used to be a business called Tata Oil Mills. I don't know how many guys you knew it. And Lakme.
Correct.
Okay. Both of that was sold to Hindustan Levers in 99, 2000.
Correct.
Hmm.
Correct.
So,
Okay.
so I think that's the cyclicality of where the businesses are. Those businesses are. Sorry, I missed the second part of your question. I missed last part of the question. What was it?
That turnarounds
So
are
the turnarounds.
sustainable in nature, because a lot of time, according to Parth, there have been few instances, that growth has come and then it has again fizzled out very quickly. So how do you decide sustainability part?
You just have to wait for the company to survive the cycle. So if you look at the 4 quadrants that we put it together, all you need to look for businesses that consolidate one of this thing. At the top of the cycle, buy the business, and if you like the business into the next decade, buy the business that is deleveraged itself, it will get back into the next cycle as a leader. So if you look at the fertilizer industry in India, the last urea plants came in somewhere at the end of in 1995 or 2000, somewhere in that bracket. No fertilizer plant came in after that. Now all the new ones are coming in and all driven by the government of India.
Okay.
So those are cyclical in nature, but the guys who survive are the guys who had the maximum amount of financial discipline. So just look at a survival ability, and you should be able to get there.
Fair enough.
Parth, anything else you would like to ask?
Fair enough. So apart from this one short, a quick question, if you'd like to answer, sir. So I would just want to know, so your pick on this sector, if you can, in near future, so just any.
Your voice is cracking.
Very sorry, am I audible?
Yeah, go ahead. Which sector?
Sir, your pick on any sector for near future, if you can.
You want to pick on any sector?
So that you think any sector for near future, if possible.
I will skip that because I don't think I have a horizon for the next 1 year. We all have very different investment horizons, so I will skip any question.
Fair enough, sir.
Related to stocks or sectors.
Fair enough. Very sir. Thank you, sir.
Thank you so much, sir. So next we'll call Anmol Singhani, is currently our student. Anmol, yeah, you can go ahead with the question.
Good evening, sir. Thank you for giving the opportunity. Sir, in an interview mentioned your investment philosophy for picking a company. You stated that when a company drops balance sheet, or in an industry where the margin are pressured and a company is not making profit, but still it drops its balance sheet and increases sales turnover, you essentially have found the one. So has this investment for philosophy been the one for you? Like, has it been evolving, or has it been the base for your current investments? Or
I mean, this is essentially return on capital employed, right? Higher market share at same capital employed. So it's so in absence of profitability. So what? Where do we step in? We step in an industry where profits is static or contracting.
yes.
So how do you pick a business? So you pick a business which goes in line with market cap to turnover, market cap to sales, or sorry, EV to sales. So if EV to sales is 0.3, 0.4, 0.5, you basically got that because market is valuing sales at 30% of what the company can deliver. That is happening because profitability doesn't exist.
Yeah.
But when the market is valuing the company at that number, we necessarily need to make sure that the company remains solvent.
Correct.
Solvency check is fairly simple, is that I'm getting incremental market share. So the consumer is picking me up. Consumer is buying my product, but I don't have to spend any incremental amount of capital to acquire more customers.
Correct.
Yeah. Got it, sir. Thank you, sir.
Got it, sir. Thank you so much, sir. Next question quickly from Maulik's side. Maulik is also currently one of the students in the academy. Maulik, please go ahead.
Hello, sir. Good evening. My question to you, sir, is how can any small player survive in the industry when disruption happens? So can you give us any example from Indian markets where actually a large company was not able to survive, but a small company came out as a big winner?
Yeah, there are a lot of them actually. I mean, not a lot of them. There are a few guys that are there. The change and disruption came in mobile telephone in telecommunications, and yeah, the smallest companies with Bharti and all the phone companies took over the behemoths at that point in time. So it happened. Okay, you had MTNL and BSNL who owned all the trunk lines in the country. Okay, and in 2000, you also had another company which was fairly large in market capitalization, which is called Himachal Futuristic, who won a number of licenses across the country, but they won those licenses on the fixed line basis and not on the mobile basis, which took them to bankruptcy, while Bharti and the rest of them bid for mobile licenses, which kept them solvent. Okay. Then another one may not be relevant from a shift in technology, but shift in spending habits is when the two-wheeler business came in. Bajaj survived because his ability to transition from scooter to bikes happened. Okay, but the guy who emerged largest was Hero Honda at that point in time. And he went on to be the largest. So Hero Honda survived LML, survived the Kinetic Group. Okay, survived, I think, Escorts, which did Rajdoot at that point in time, all those brands that existed. So he survived all of those companies at that point in time. I think those are the two relevant ones that were there. And those are large industries that we saw.
So I would like to add on Maulik's part. So like, what was the common between DNAs of such companies which survived? Because in Insight we have examples, but according to you, what were some specific and angles that they were good at that actually made it happen, that they could survive?
It was what the customer wanted.
Okay.
His ability to understand customer requirement, and they just delivered on that.
Okay.
Okay. And I mean, the first guy to pick up the trend of fill it, shut it, forget it was Hero MotoCorp. Fuel efficiency platform on personal mobility in the absence of public transportation. Two-wheelers in India is a proxy for a lack of or inferior public transportation.
Correct.
Okay. After you used to wait 10 years for a phone at home in the 80s. Okay, maybe longer. And you walk into a shop and you buy a mobile phone. At that time, we used to pay 13, 14 rupees per call and 7 rupees for incoming and 13 rupees. But that was convenience of holding a phone and being connected. You didn't have to go to a landline, pick up the phone and talk to people. So that was mobile telephone. So it's the evolution of being first to market that helped them help them go through with it.
All right. Thank you so much, sir. I think from the student side, this will be the last question from Nawaz Godil. Nawaz, can you please go ahead with your set of questions?
Hello, sir. Good evening, sir. Thank you for giving me an opportunity to talk with you, sir. As I had listened in one of your interview that you had invested in sugar since 1999, sir. So, what is the reason behind this? And sir, this industry is more cyclical than others, and also regulated by the government. And sir, we can get a figure of about 18 to 20% in other industries also. Sir, what is your main reason for investing in sugar? It is more cyclical than other industry.
So it's an industry that I know very well. So first thing that you always need to do is always invest in something that you know very well. Okay, the probability of you getting it wrong is reasonably low. So what I like about commodities and sugar more specifically is that when you are on the turn of the cycle, all your money is made from inventory.
Inventory gains.
Yes, all your money is made from inventory. And at points in time, at multiple points in time, the inventory which is sitting on sugar company's book or the change in inventory or sitting on sugar company's book is equivalent to the market cap and in some cases the EV of the business itself. So that effectively means that if he sells all his inventory, he can pay down his entire enterprise value and his his debt in one go, which is a 1-year payback. How can you dispute an argument of 100% payback?
Correct.
So that's why I'm very attracted to that business, because I know how inventory computation takes place. I know sugar prices. I can do a mathematics at the back of the envelope, and I can actually buy that. Of course, the business has changed substantially since then. Now it is all about ethanol and not about sugar. So I continue to grapple with that ethanol story with these guys. But sugar was very simple.
Correct. Got it. Got it, sir. Now, anything to add?
No, sir. Thank you.
All right. Sir, it's 5:20, sir. Just two questions from our side. These are our questions from the faculties. Sir, I think last we met in 2017 at your office, when I think you had just started Old Bridge. And we had this discussion. I don't think you remember that or not, but you explicitly informed me that for an equity market guy, it's much more important to track bond market. And you would definitely put your money on a bond market specialist rather than a equity market specialist when it comes to judging market cycles. So sir, I actually want to understand that what kind of data points, few of them we know, the corporate debt to GDP or GSEC cycle affecting the PE ratios, but a bit in depth regarding your ideology on connection between bond to equities.
Let me see if I can find that chart. I mean, so bankers create the entire bubbles in equity markets. Okay, that's what I always believe, and it's not very difficult to figure out where and why and how. But if I can just find that out. So just give me a minute.
Yeah, sure, definitely, sir.
So I've got this in a PDF format, so excuse me in this, but so these are the credit markets. Right. Let me just get a presentation from. So these are the credit markets as we know. You can see my screen, guys?
Yeah, yes, sir.
So these are credit markets for us. Okay, and though the 90s was not a very well-formed credit market, I'll just go back to 2000 and see it, 2000 to 2010. So we've got nominal GDP growth that is there, and we've got household credit, and we had corporate credit. Okay.
Correct.
And this is how corporate credit was growing during that period, and this was how household credit was growing. So household credit completely tanked.
Right.
Right. And corporate credit was coming here. And guess what created the bubble in infrastructure and real estate and everything else that was there? It was the credit markets.
Correct.
Okay. And And when I said 1% was levers CAGR return during 2000 to 2009, this explained it in this graph.
Household credit.
Yes. So when the consumer was deleveraging, obviously he had very weak purchasing power.
Correct.
Right. And when corporates were leveraging, they had high profitability and extremely high ability to leverage. So you knew where you had to be during that period of time. And from 2010 to 2020, look what the banks leveraged. So this is services credit and this is household credit. Services credit is nothing but 50% of it is real estate loans.
So I think we're not able to see after 2010 wala chart.
Oh, you have not?
Yeah, we are.
Yes.
This for the first.
Usually happens. So this is the one. Huh.
Yes.
So this is what happened in 2010 to 2020. Again, this is visible.
So this is very small. I think you will have to maximize it or zoom it one. Yes, perfectly visible, sir.
Okay. So this is what happened in 2009 to 2020. Household leverage increased, real estate leverage increased, and corporate balance sheet deleverage, which is what I also showed you in the NSE 500 slides. So all you need to do is track where the money is going, which part of the economy it is heading towards, and you can pick a bubble completely.
Correct.
Okay, so so the next slide actually shows you even something better.
So you fetch this data from RBI's website.
This is all RBI data. Yes.
RBI data, right?
You can see this slide?
Yes, sir. Completely.
Now, when we're talking about consumption and we saw household leverage getting created, this is how household leverage got created between 2009 to 2020. Per capita consumption has been ahead of per capita disposable income.
So the difference is coming through leverage.
The difference is coming through leverage, which is why corporates deleverage, and the entire rush of companies that were there, whether it's the private sector banks or NBFCs, all went to consumer leverage, including microfinance businesses. So what we think is coming into the next decade is a deleveraging of the consumer crisis, consumer credit.
Okay.
So in short, I would say this again, that I love to see leverage in the economy. I love to see the bond markets. I like to see where people are parking their capital and where the yield rates are the highest. That's probably where the bubble is being created in equity markets. Always remember, equity is 10%, debt is 90%.
Correct.
You have to keep looking for where the maximum amount of liquidity is actually going, and it's not us equity investors.
Correct. Got it. Thank you so much. Answer. Just last question quickly. I have 4 more minutes. Sir, how do you exactly quantify risk of a business? And this is apart from normal cyclicality. A company launching a new product which you are banking on, it goes wrong. The plant capacity utilization doesn't picks up, or the promoter board hassle happens, and the new management team has to come. XYZ, any risk. Do you price in with capital allocation because you take equal weight, or you price in everything at the valuation domain? Like, how do you go about quantifying risk?
So quantifying risk, I mean, for us, it is an individual. It's related to. So there's one portfolio risk that you can control it through allocation into a particular company, and second is at a portfolio level, construct a company risk that you can price in. Right? At a company level, you just have to make sure that the expansion, product innovation, etc., is not significantly larger than the cash flow of the existing business. So let me put it differently. Cash flows of a business go into creating alternative lines of business.
Correct.
If that business virtually goes down to zero, it shouldn't affect the existing continuing cash flow of the company itself.
Okay.
As long as that visibility remains and continues to remain, you're pretty okay companies incrementally building out capacity. So to give you a sense, the aviation business, the FMCG business, the telecom business, okay, operate in that metric, right? So Bombay, Delhi end up being the biggest markets for everyone, or used to be the biggest market. Now Bangalore is. You use cash flows in that business from that territory to create another circle or to create another route.
Correct.
Okay, then you isolate both those routes to see route, or isolate both the circle to see how much is making money and how much is losing money.
Losing money. Correct. Got it.
Okay, and that goes back to what the company individually does.
Correct.
So do not invest ahead of what demands you see happening on the ground. I think that is one of the biggest problems that a lot of companies have done, where they've invested significantly below before the market got created.
Correct. Got it. All right, sir. And just sir, final. I have heard you recommend One Up on Wall Street or Capital Returns a lot of time as a reading material. But sir, apart from those standard reading materials, can you please tell us one or two or three books, investor memo, etc., anything that is basically unheard of, but it has helped you tremendously in your investment journey?
So I'm on to this one book just now.
100
it's
to 1.
fairly interesting.
Okay.
Okay.
Thomas Phelps, right?
Yes.
Yes.
It does teach us a lot on what history is all about.
Okay.
But it's fairly interesting. It's a very different perspective from what I've seen before. But it goes back to the same fundamentals of businesses.
All right. And sir, any particular investor that you admire the most?
I think everyone has their place around. Okay, everyone's got their styles that have worked. But more than investors, I admire entrepreneurs who've been able to branch out and create different business models and work as equity. See, look, the world's largest equity investors are entrepreneurs.
Correct.
Right?
Right.
While Amazon does a lot of logistics, its biggest profit pool is sitting in the cloud.
Correct.
Right. And that's what we need to learn from. So he's putting in a portfolio out there.
Correct.
Okay, and capturing opportunities and changing the way that the world works.
Correct.
Right.
Absolutely.
So that's the way it goes. But otherwise, there are I wouldn't by spelling out one particular investor. I'll be disrespecting a lot of other guys who've done extremely enormous amount of work or credibility, earned a lot of credibility out there.
Absolutely, sir. Sir, just one question, so I will take one more minute. Sir, do you do a lot of on-ground research also while studying businesses? And how do you develop those network? Because I am asking this not for me, but for my students, because they have faced a lot of difficulties while they're analyzing industry. It's not easy to develop supplier and buyer connects to understand what is happening on ground. So how did you go about this when you were young?
It's fairly elementary. I mean, we used to have a company in our portfolio called Page Industries. So anytime anyone went out shopping, you just go to the stall where Jockey was available. You look at manufacturing date.
Right.
You'll know how fresh the inventory is. Then go to the competing brand, look at manufacturing date, then see how old the inventory is. So you know who's getting higher market share.
Correct.
Okay, those are very simple ways of actually doing it. You don't necessarily need to go and talk to a stockist or distributor or anything out there.
Got it, sir. Thank you so much, sir. It has been two hours. Amazing data insights, everything crystal clear. We are highly obliged, sir.
I hope it helped. And
very much,
Investment
very much.
that's-
And in fact, we are so much thankful that we requested for an hour's time, and you actually gave us a lot more. In that 2 hours time, we feel that we have learned a lot. So genuinely, thank you so much. I mean, the old memories of your previous session at Finacle, literally, it's something more now we have to talk about in the upcoming days. So genuinely, we want to thank you, sir, on behalf of all of our students as well as Viti.
take care.
And I hope so it was good for you too. Not very basic.
No, I think you guys did a great job. Questions were very insightful. I was very happy when I saw the questions. Okay, I struggled with some of them, like you saw, but I hope I will never have answers to everything. The day you find an investor who has answers to everything, then you should just invest.
I don't think we'll find one.
Okay, so yes, there are opinions, but there are never end solutions.
Absolutely, sir. Thank you so much, sir, once again.
Super.
It was a pleasure, sir.
Thank you very much.
Thank you so much, sir.
Bye-bye, sir.
Bye. Take care.
Hope to see you soon, sir. Bye.
Bye.